Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. Happy Sunday. I want to thank each of you for joining me this morning. My name's Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show. Happy Memorial Day weekend. Thank you to all who have served, who sacrificed their lives so that we can live in freedom in the greatest nation in the history of mankind. Hope everyone has big plans for the weekend. I've always enjoyed Memorial Day weekend. It's kind of the intro to summer, so to speak, but it's also graduation week this week. My son's graduating from high school, and we're celebrating that, and we're having a great time. So I hope everybody else out there is enjoying it as much as we are. Today's show, I was exchanging some emails with a listener, and his name, coincidentally, is Mike as well. So, Mike, I want to thank you for that conversation. But he sent me an email, and it was about a self-directed IRA. It was about owning real estate within a self-directed IRA. And if you'd like to send me an email, if you have questions on real estate investing, I do respond to those personally. My email address is askmike@luinc.com, askmike@luinc.com. Let's see if we can't tackle this discussion for the remainder of today's show. And I want you to understand something up front, though. Investment decisions are personal, and they're unique to the individual. Everybody's at a different point in their life. And I am not a financial advisor. I'm not a real estate mentor. We have those at Lifestyles Unlimited. I am a real estate investor in single-family homes and apartment communities. I'm a partner in over 2,400 apartment units all over Texas. But there are folks who are eminently more qualified to answer this subject than I am. I believe I'm somewhat qualified to discuss it, though, and we're going to, because that's exactly the path I took 10 years ago when I first got into real estate investing. I did it within a self-directed IRA. So I have done this in the past, and we'll discuss how that is and my thoughts on the self-directed IRA. At the time, I thought I was making a very, very smart move. I really did. I didn't know what I didn't know. Turns out I made an okay move. Not a great move, not necessarily even a smart move. It was an okay move, and more on that thought later. Let's discuss this strategy in detail and see if I can provide some insight. And what I'm talking about is physical ownership of assets within an IRA. Physical ownership. I'm not talking about a REIT, for instance. And if you don't know what a REIT is a real estate investment trust. It's essentially, it's a mutual fund that buys real estate assets. But what you're buying is a stock. You're not necessarily buying the asset itself. So I'm not talking about those at all. I am talking about physical ownership of property within an IRA, a self-directed IRA. And throughout the show, I want to go into what I'll call issues associated with the physical ownership within an IRA. I'm not going to call them problems. I'm not going to say it's the wrong move, but where I'd like to go today is there's a more effective way to do it. And I've identified 5 total issues, possibly a 6th issue. But the 6th won't pertain to everybody. The first 5 issues will pertain to everyone. The 6th is certain circumstances, and we'll get to that toward the end of the show and go through it, so I hope you can stick with me. But real estate is a much better investment than stocks, hands down. Much, much better. It performs better. It's safer when done correctly. The returns are significant, double and triple-digit returns. But owning real estate, even if you own it within a self-directed IRA, That's better than not owning it at all. That's better than not owning it at all. And if that's what gets you started on that path through the self-directed IRA, that's okay. But there's a more effective path that you can do, and that's owning the properties outside of the IRA, not within the IRA. Now, why would someone consider buying real estate within an IRA to begin with? Why? Well, for most people, once they make up their mind, essentially, once they say, yes, real estate's a great investment, I want to own some real estate, obviously that takes money, and a lot of people don't have a lot of cash on hand. It doesn't take as much money as you think it does, but you still need some money to get started to take down and purchase real estate assets. And so people say, well, I don't have $25,000 or $50,000 in my checking or savings account, but I've got a pile of money in my IRA or my 401k that I've been feeding for 10, 20, 30 years. And so once they reach that point in their life and they say, yeah, we're going to buy some real estate, how are we going to do it? And then they look at the IRA and they say, well, we're going to have to do it within the IRA. That's where I was, essentially. There was other avenues. I had other funds on hand that I didn't really realize or consider at the time. Keep in mind, this was 10, 11 years ago. So I looked at my IRA and I said, there's some money in there, and that's what we're going to use to purchase real estate assets. Now, at the time, 2010, 2011, it was hard to find a company that performs self-directed IRAs. I know they're everywhere right now. You can get online and type in self-directed IRAs, and there's going to be 475 million companies out there that'll be more than happy to do it for you. This was then, this is not today. And another issue I had back then was the paperwork. There was no such thing as DocuSign, and you couldn't fax documents in. They wouldn't accept a fax. So they had to mail you the documents, and you had to fill them out, and then you had to mail it back. So it was kind of difficult to set it up back then. But I don't think it's difficult today. That's not one of my issues. So we're going to come back. We're going to continue this discussion on why it may be more effective to own real estate outside of an IRA than within an IRA. My name's Mike Harrison.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. Hope everybody's enjoying their Memorial Day weekend, their 3-day holiday. Easily one of my favorite holidays. Today, I'm discussing owning real estate within a self-directed IRA. And I'm going to compare and contrast that to owning it outright, owning it personally, not within an IRA. And I'd like to shine some light on it. I've identified 5 issues with owning real estate within the IRA, and that's a path I took 10 or 11 years ago, and at a time when I didn't know what I didn't know. I'm not upset that I took that path because ultimately it's what led me to Lifestyles Unlimited. It was my way of getting started in real estate ownership, and I purchased a very nice home within my IRA, and it's a home that was worth very close to $200,000 at the time. I mean, it was super nice. I mean, wood tile throughout, granite countertops, crown molding, super nice neighborhood, 4-bedroom, 3-bath, but it wasn't the most effective way to do it. And I learned that. And eventually I pulled that home out. I cashed in that IRA and began buying rental property assets outside of the IRA. Why are we debating this today? One, it was essentially a discussion I had with one of our listeners who emailed me. And if you want to email me, that's askmike@luinc.com. Ask Mike at luinc.com. And I do respond personally to every email I get. But today, the self-directed IRA is more popular than ever. I mean, there's commercials all over the place on it. And I think mostly what you see is how to buy gold in your IRA. And it seems that those commercials are targeting the senior audience. That's my opinion. Maybe they are, maybe they aren't. The other reason is more people are discovering that real estate is really a much better investment than stocks and bonds and mutual funds. So a lot more folks are getting into this space and they're wanting to purchase real estate. But what happens when they make that decision is they realize they need some money to get started. Yes, you do need money to get started, and they don't have a lot of cash on hand. And so they're kind of in this personal dilemma. They're saying, yeah, I want to do this, but at this point, all my money is trapped in this doggone IRA that I've been feeding for years and years and years. And so the big pickle is I don't want to take my money out because I don't want to pay the 10% and I don't want to pay the taxes. Look, you're going to pay the taxes. All right. Everyone needs to just get over that hurdle. You're going to pay them one way or another, but the taxes will not go away. It's really the debate with yourself should be the penalty. And again, I went through this. So what are the 5 issues? Issue number 1, the fees. There are a multitude of fees associated with this self-directed IRA, and they're fairly steep. First of all, you got to set it up, and they're going to charge you, most companies, well over $1,000 just to set it up. Thank you for setting up your self-directed IRA. You owe me $1,000. And then there's these annual maintenance fees, and those are easily over $1,000. So again, this is supposed to be a retirement program, and the fees are astronomical. There's also, because you're self-managing it, you need to set up a checkbook within it, and they hit you with costs associated with that. There's custodial fees, there are asset purchase fees, good Lord, expense fees, setup fees that I mentioned. Again, all these fees are in there so you can run your own IRA, your own self-directed IRA. So I think these companies that do this are taking advantage of people in that regard. The fees are ridiculous. Now, on the opposite side, some of you may be thinking, well, Harrison, you've got fees associated with real estate. I do. I've got management fees. I've got property taxes. I've got closing costs. But you need to remember 2 things. I've got those built into my deal beforehand. I build them into the deal beforehand, and then I calculate my cash-on-cash return, my equity capture, my annual return. So I build those in, and if you're buying real estate in your IRA, you've got those same things too. You've got management fees, property tax, closing cost. But something to remember as well is I'm writing off those fees as a business expense. The IRA owner does not get that advantage, and we'll talk more about that later in the show, but that's because the asset is within the IRA. You don't necessarily own the asset per se. You own an IRA that happens to own a real estate asset. It is different. So the fees is my first problem. My second issue, leverage. My friends, what we do in real estate, we use leverage on every deal. We bring a partner to every deal. And that's the bank. The debt within the IRA, first of all, 10, 11 years ago, I was told by that IRA custodian that I could not have a loan whatsoever within my IRA. I realize today you can, but you can't have your typical traditional Fannie Mae or Freddie Mac. You have to use what's called a non-recourse loan, all right? Essentially, the debt in the IRA cannot be personally guaranteed. So you either pay all cash for the asset, which is what I did. Quite frankly, I didn't think you could get a loan within an IRA, and I was a Dave Ramsey guy. I was not going to consider that back then. But what does leverage do for the deal? Let's talk about my property. So I had this home. It was valued at, depending on when I got it, between $180,000 and $200,000. It was earning about $1,650 per month. That was the rent was $1,650. Again, this is a paid-for home within the IRA. That's a 9% return before I paid property tax. I mean, after I paid property tax, it's probably more like a 7 or a 7.5% return. But if I had used leverage, I could have taken that money and, again, this is 10, 11 years ago, I could have purchased 8 more houses, 8 instead of 1, using leverage. Each return, each home paid about $500 per month. That was $4,000 a month. That was $48,000 per year. And that's all in. All in. That's including my property tax was built into that return, my PITI, right? Your principal, your interest, your taxes, and your insurance. But that $48,000 is a 24% return, not a 9% return, or even a 7% return, right, after I paid my property taxes within my IRA. So do you see how leverage in what we do makes our investing so much more effective? And there's something else you need to overcome, because if you're looking at this, buying this house within this IRA because you're adverse to debt management, my friends, you're going to have to get out of that mindset, because real estate investing is debt management. My name is Mike Harrison. We'll be right back to continue this discussion.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. I'm your host, Mike Harrison. And yes, we're always working on your financial freedom. We're having a discussion this morning regarding the self-directed IRA. It's a lot of people look at that and buy property within the self-directed IRA. They feel that's the best way. And for some people, that may be right for you. I'm not saying it's bad. I'm just saying there's some elements to that self-directed IRA that you should be aware of, and you could be much more effective by owning those properties outside of the IRA. And I've identified 5 solid issues. We've touched on 2 of them. I actually have a 6th issue we'll get to at the end of the show that probably won't affect most people. But the 5 will affect everybody. But before I get into that, I want to touch on our expo. Our Lifestyles Unlimited Real Estate Investor Expo is in Irving, Texas. It is Labor Day weekend. That's September 3rd and 4th, Friday and Saturday. We're going to have the exhibit hall with our experts there. Our vendors will set up. The radio team will be there in the expert hall. We're going to have breakout classes. If you want to come sit in on some hour-long classes on every possible subject, whether it's single-family investing or passive investing in apartment communities, those topics will be covered. Taxes, management, finding a property, everything and anything. There'll be over 5,000 investors at this show. We had over 5,000 last year, and it's definitely the largest event of its kind. So I can't say enough great things about our expo. I remember vividly the first one I ever went to. It was incredible. If you want more information, that's wealthandpassiveincomeexpo.com, wealthandpassiveincomeexpo.com. And if you want to save $97 off any pass or package, enter promo code, when you're getting your tickets, enter promo code Mike, and that's all capitals, M-I-K-E. On to these issues with and I want to call them issues. I'm not going to call them problems, okay? I'm just going to say there's issues with owning real estate within a self-directed IRA. And again, I did this. It's what ultimately led me to Lifestyles Unlimited. And once I became more educated, I rescued those funds out of my IRA and 401k. I freed them, and I began investing in real estate self-ownership, essentially. So I'm not tied to that IRA or that 401k. My first issue was fees. The fees are exorbitant. They're going to nickel and dime the heck out of you. My second issue is leverage, because leverage is so important to what we do. Now, can you have leverage on an asset in your IRA? The answer is yes. And I didn't know at the time. My provider 10 or 11 years ago, either they didn't allow that but they just flat out told me no. But you can do this. They have to be non-recourse loans, which means they're unique lending products. They're boutique lending products, let's just say. They have terms and rules associated with them that make them somewhat unattractive. Okay, they've got higher rates. They're a shorter term typically. They may have adjustable rates. They may have prepayment penalties. A lot of these loan options have prepayment penalties. But the bottom line here is nothing beats a good old-fashioned Fannie Mae or Freddie Mac 30-year mortgage with locked-in low rates. Nothing beats that, especially if you're using other people's money, right? Leverage. We're using leverage here. We're using other people's money to purchase these assets so that we can get our returns into these double-digit and triple-digit returns. Issue number 3. I'm going to call this issue, and it's a mindset thing. It's a mindset thing. But I'm going to call this issue with owning real estate within a self-directed IRA, I'm going to call it the complacency paradigm. The complacency paradigm. What do I mean by that? Well, to begin with, an IRA is designed, for one, not to have access to the funds until they're 59 and a half, right? That's when you can start withdrawing. That's the age the government has assigned to you to possibly begin retirement. Actually, the government would prefer if you waited until you were at least 66 or 67, depending on your age, because that's when you get full payment of your Social Security. But we're not talking about that right now. But there's rules associated with this IRA, and breaking these rules creates a financial penalty. We live in a world where the government will pay people not to work, to sit at home, to eat junk food, and play on their $1,000 iPhones. But if you dare access your money in your IRA or your 401k, your money, the government will fine you. Think about that for a moment. Think about that. Issue number 3, this complacency paradigm, is you are accepting that you will not retire until 59 and a half. And I disagree with that. Retirement is not an age. It's a financial condition. If you can make your money work for you to such a degree to where your passive income comes in and it exceeds your monthly obligations, for instance, let's say you have $4,000 in whatever, mortgage, living expenses, food expenses, car note, whatever, and your passive income is $4,500 a month, do you need to go to work? No, you are free. You can retire if you want. But if you're buying these real estate assets within this IRA, you're basically telling yourself, man, I'm not going to be free until I'm at least 59 and a half. And I don't want you to get that mindset. I want you to believe that you can retire within 2 to 5 years. We teach that here at Lifestyles Unlimited. So don't wait until 59 and a half. When you're buying these assets in there, it's reinforcing that mindset. Hey, I'm not going to touch this for 10 years or 15 years or 20 years or however long that is in the future. And I want you to enjoy freedom and your life now, today, as soon as possible. So that's my reason number 3 is this complacency paradigm. Don't get complacent. Don't sit down. Don't lay down. Reason number 4. This one's the most important reason for me. My most important issue with owning the real estate within the IRA. There's no cash flow. None. At least not to you personally. The income from a property must go back into your checkbook IRA account. The owner of that investment is literally the trust company for the benefit of your account, and therefore the recipient of any cash flow off of that property must go back into the IRA. So you're buying this rental asset, and the big reason we buy rental assets is for the cash flow, but you're just the custodian. You're just the manager. All that extra money goes back in. The resident pays the rent within the IRA, and you pay any associated fees, right? Your taxes, your insurance, all that stuff. But all that extra cash flow goes right back into the IRA, right back into it. So you need cash flow to retire, to attain financial freedom. Again, retirement's not a pile of money. It's a financial condition. I invest in real estate. My number one reason, cash flow. Our number one rule here at Lifestyles Unlimited is don't lose money. And rule number 2 is it must have cash flow. The definition of investment is cash flow. But if you're managing this IRA and all the extra money is going right back into the IRA, you're basically just giving it back to this third party, essentially, that's saying, you're not going to get this money until you're 59 and a half. And if you try to get it, we're going to penalize you. That's the primary reason for me above and beyond everything else. You know what's amazing, too? Let's go back to the fees for a second. You're taking on the duties as the custodian of the IRA in a self-directed IRA. The custodian of it. You're doing all the work. You're managing everything. You're collecting the rent. You're making sure the rent goes back in there. Yet they're still nickel and diming you with these fees to be your own custodian. Kind of ironic, in my opinion. My name is Mike Harrison. We'll continue discussing issues associated with owning real estate within an IRA.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. I want to thank each of you for tuning in with me this morning. My name is Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show. And as always, we're working on your financial freedom. Today I'm discussing the process of owning rental assets, physical rental assets within a self-directed IRA. For some people, they feel that's the only way to do it. And primarily, a lot of people, they understand that you need cash to get started. And so they look to their IRA as the big pile of money, right? You've been feeding it for 10 years, 20 years, 30 years, and there it is. And so they purchase the asset inside of the IRA. I took that approach. Back then, I didn't know what I didn't know. There is a more effective way. For me, it was more effective, and I've outlined several reasons. I've got 5 solid reasons. I've got a 6th that I'll get to here in just a few minutes, but that 6th one doesn't necessarily apply to everybody. Now, where did I learn to be more effective? Well, I learned it from Lifestyles Unlimited. How can you see what we do? Well, we have a workshop, a free workshop live stream, freeworkshoplivestream.com. You can tune in, you can ask questions, you can tune in with your spouse, your kid, anybody, and it's interactive. Hey, you're not just watching a webinar. That'll teach you how we make money 5 ways on our houses and 6 ways on apartment communities. Yes, we invest in apartment communities. I'm a partner in over 2,400 doors of apartments all over Texas. Now, where I became really effective was once I joined, I went to our 2-day seminar. Once you join, you can have access. You can take the 2-day seminar as often as you want. I've done it 5 times now already. The membership price is $297 for 2 years. That is way cheaper than when I joined, way cheaper than when I joined a long time ago. There is a promo code to get that low price, and that's all capitals, Save Big, SAVEBIG, no spaces, Save Big, and you'll find that at financialfreedomlivestream.com. Are you seeing the pattern? So the issues I have with the self-directed IRA, 1, the fees are exorbitant. They're going to nickel and dime you at every opportunity. 2 is the leverage. You can't get your traditional loans on these rental assets. There are some boutique loans or private money or that sort of thing. But again, those have to be non-recourse. So that comes with its own set of circumstances. So the leverage is essentially nullified within the IRA. 3, I call it the complacency paradigm. And that's essentially, I think you're settling because an IRA says you can't get these funds without penalty until you're 59 and a half. And I think when you buy into that mindset, you're telling yourself, I can't retire until I'm at least 60. And I don't want you to buy into that mindset at all. I want you to retire on your terms when you're ready, and I want you to live the best life you possibly can, and I want you to live in financial freedom. And I'm saying that on Memorial Day weekend. Memorial Day weekend. And as you celebrate Memorial Day weekend, and we will celebrate it, I want you to take a moment and honor, in your mind, honor those that laid down their lives so that you can live in freedom and celebrate. Let's talk about that fourth reason. I was going into it in the last segment if you missed it. That's cash flow. You don't get to keep that extra money when the resident pays the rent. You have to put it all back into the IRA, and that's the number one deal breaker for me. Now, back when I did it, I didn't think that was that big of a deal. You know, hey, we're making money, I'm just putting it into the IRA. But the secret sauce here is what if you can keep that cash flow, right? What if you can keep that cash flow and compound it and build on it, and then pretty soon you have enough passive income coming in that you can retire. You can live life on your terms. You can do what you want, when you want, where you want, with whoever you want. Now, there is a contrary to the no cash flow. And for many, this is a disappointment. So if you can't keep the money that's coming in yourself, you have to put it back in the IRA. At the same time, the IRA must pay any fees associated with the property. You cannot do these out of pocket. What do I mean by that? The grass is high. You want to go over there and mow the grass on your own rental property? No. That property is owned within an IRA, and the IRA needs to come out of the IRA, the funds associated with that. You're not allowed to work on your own property in any way, shape, or form. Simple roof repair, you can do it yourself for, maybe $100 out of pocket. Nope. You have to hire somebody. There has to be a receipt associated with it. Now, again, they have these self-directed checkbook IRAs today, and you may be saying that's no big deal, but there's a lot of people that like to work on their own properties. Now, we teach you to hire somebody at Lifestyles with our motto. We say you don't need to be the person with the hammer or the paintbrush in your hand. But again, there's a lot of people that really, they like it. They have the time. They say, you know what? I'm going to work on my own property. You're not allowed to do that. Now, 10 years ago, when I had my IRA, it was a giant hassle. The check had to be cut from the provider. I didn't have a checkbook, so I had to find a contractor, A, that trusted me enough to do the work, and B, that didn't want to get paid or was okay. Yeah, I don't want to say didn't want to get paid. He or she was okay getting paid 10 days later. And I'm sitting here, with the hat on my head with the propeller on top of it going, well, the check's in the mail. I mean, it was a giant hassle. And look, contractors should get paid as soon as they're done with the job and they do a good job. They shouldn't have to wait for their money. So that was a big issue, but you're not working on that property in any way, shape, or form. And you're having a paper trail, right? I mean, everything you pay, you're identifying that expense. Remember, you're a custodian of the IRA. So there's some work there. What's reason number 5? This one's solid. There's no tax benefits other than what's already baked into the IRA or the Roth IRA. Those IRAs are designed to have tax benefits, okay? Essentially, you either pre-tax the money and pay taxes at the end. You either utilize pre-tax money or you pay the taxes at the end when you pull it out. On a Roth, you use post-tax money and get tax-free withdrawals on the back side. The whole thought on the IRA is you'll have a lower tax bracket when you retire. I'm not going to go into that. I don't think anyone's going to have a lower tax bracket in the future, quite honestly. But real estate is already tax advantageous. It's one of the main reasons we do it. We're deducting all expenses, the taxes, the management fees, the insurance, the mortgage interest. We're using the depreciation of the asset. That makes our cash flow either tax-free or darn close to it. What income we do report is taxed at the capital gain rate, which is a much lower rate than ordinary income rates. But when you're pulling money out of your IRA, when you finally get to do that, you're going to be taxed at your ordinary income rates. Traditional IRA withdrawals are taxed at ordinary income. At death, I can pass my real estate assets to my heirs at the stepped-up basis, tax-free. If I leave my heirs a traditional IRA, they will pay tax on the distributions. Keep that in mind. All right, so putting real estate in an IRA actually makes the real estate less tax-friendly. It makes it less tax-friendly, not more tax-friendly. We want to get away from taxes. Now, reason number 6. This will not apply to most people, but it's another issue with owning real estate within the IRA. It simply states you cannot live in the property for any amount of time. Remember, this is an asset within an IRA. It's not one that you can work on and improve yourself, and the same extends that you cannot use the asset for personal use in any way, shape, or form. And you may be thinking, well, Harrison, I'd never want to live in one of my rent properties. Well, don't think of it like that. I can think of two occasions when you might. The horrible thought of divorce, a couple splits up, they own some rental properties, and one of them just says, I'll take these 4 rent homes, I'll go live in one of those. That's terrible, but it happens to people. No, you will not, though. You will not live in that if it's owned within the IRA. So that's not an option. But the more realistic thought here is, I know a lot of folks that started in real estate and they would buy a duplex, for instance, and they would live in one side and lease out the other. I had a gentleman on the show just a few weeks ago, Daniel, and Daniel's doing fantastic with his real estate investing path, but he started a while back with that, I'll buy the duplex, the resident on the other side will pay their rent, and with that extra money, I will pay the mortgage and essentially live in the duplex for free, or the fourplex, live in one unit and rent out the other units, right? There's a lot of folks that do that, and they manage the property themselves. You cannot do that if that property is owned within an IRA. So it takes that option off the table for you. So the bottom line is the IRA is, look, do some people do it? They absolutely do it, but it's more effective to own your real estate outright. It's more effective to own it outright. My name is Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show. I want you to remember, it's not the money, it's the lifestyle. Have a great weekend.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.